Hello, I'm Dave Feinlieb, and this is Beyond the Shelf. This show is an open exploration of the people and process behind e-commerce. Through conversations with innovators in the space, we learn the stories of these leaders and their strategies for e-commerce success. You can find out more about how we're helping leading brands and retailers optimize content at scale and learn about our new sell sheet builder at itsrapid.ai. My guest on today's show is Matt Nicklin. Matt is a managing director and co-president at First Analysis Securities Corporation, a leading investment bank and venture capital firm. Prior to First Analysis, Matt was vice president of corporate finance at William Blair from 2000 to 2010. Matt and his team focus on tech and healthcare investments and have been involved with a number of e-commerce related transactions. I thought it would be of interest to our listeners to hear Matt's perspective on the e-commerce market and tech more broadly. Nothing discussed or said during today's episode should be construed as investment advice. We discuss Matt's experience at First Analysis, his recent transactions, and his outlook for 2024 and beyond. Please enjoy my conversation with Matt Nicklin. Matt, welcome to the show.
Thanks for having me, David. Great to see you.
Take us back, if you would. How did you get your start in the industry?
I had kind of a unique start. So I came out of college planning on going into medicine and fell in love with marine ecology my second semester senior year in college. So I actually ended up going to graduate school to become an intertidal evolutionary marine ecologist, intertidal ecologist.
Wow. Tell us what that means.
What it means is ecology is studying how organisms and its environment all interact together. And what I really liked about it is you could figure out how things work together. So for example, I worked with a lot of snails, and I could see that if you grew snails in the presence of a crab, they would grow significantly thicker shells in 45 days than those that were not in the presence of a crab. Those differences could be different for crabs picking up snails on the beach for natural selection, but those are also the kind of differences that you see in the fossil record that a lot of times people would think were shifts in species. So it kind of was a difference between how you look at these things. But either way, like ecology is storytelling, and it's very quantitative. I teach statistics and those sorts of things. And so I kind of developed this approach to data-driven storytelling through that and figuring out how it was. So I really enjoyed that. But, in ecology, which I adore and still love, it didn't exactly pay the bills. And so instead of living in a swamp for the rest of my life, I started doing some consulting work and realized, there's this whole other world out there. And it was in 1999 when people would hire you with crazy backgrounds.
What a great story. Now, I've got to ask you, when you take the kid to the aquarium, are they excited about that, or how do they view your experiential knowledge of ecology and biology?
It often depends. They can find it exhausting. So my teenagers don't like it as much as they did when they were much younger. But no, I love it. I'll go to any aquarium you want. I'm game.
So great. So great. For those of our listeners who might not be as familiar with public markets and private equity and some of these things, will you take a moment just to tell us how do the different parts of the market work? What are the differences?
Sure. So I think there's 3 or 4 buckets of equity that you can get. Most people are very familiar with venture capital, which is a form of private equity, where people write growth equity checks into your business, right? And those tend to be for earlier stage companies. Then you have growth equity, which tends to be larger checks into businesses that are more established with meaningful revenue. Then you have private equity, which tends to be larger checks and buying majority control of companies where they're more operators. And then you have public companies, which are companies like Amazon or Microsoft or Oracle or you name it, Salesforce, where they are much larger companies, but where they get sold into the public market and people can buy and sell their shares in a highly liquid place. All of them work in terms of how you get access to that capital, but the ease with which you're able to buy and sell those things get much easier as you're public and much harder when you're in the private markets.
That's great. And that, I'm guessing that's why you think about how the investment bankers work with these various parties to help raise capital, understand the structures of these different entities and so on.
Exactly. And basically private equity firms and growth equity firms, they're great. And I work with them all the time. But I wanted to focus on the needs of the entrepreneur. I felt like if you're spending most of your time working with private equity firms, you can kind of really standardize and build really efficient processes to sell to them. And they're excellent buyers and wonderful partners. But if you're also sourcing most of your business there, I felt like entrepreneurs weren't necessarily getting the same level of attention. And it's a little bit more work, to be candid. So I joined First Analysis 14 years ago because we had this practice where we had all this great research, where we cover a bunch of different sectors, all B2B software and Internet of Things kinds of areas, and where we do direct investing from our venture fund, where we're still actively investing from our venture funds and raising new funds on a pretty regular basis. And then where we could also do advisory work for the same kind of entrepreneurial businesses for larger businesses. And so it was a great opportunity where I had my Jerry Maguire moment and said, I'd like to work with less companies in a way that's consistent with the way I'd like to. And so there's nothing wrong with all these other firms. They're great. But it's just kind of more of a focus that kind of felt empowering and kind of on my own entrepreneurial journey is why I did it.
Your dad, you're fortunate enough to work with your dad who founded the firm. What's that like working with your dad at the firm?
It's gotten better and better. It was challenging at first, and I always joked, I would have joined the firm earlier if he weren't there. But my father's been great. He's got this really great perspective. He's much more on the research and been a direct investor for many, many, many years. And it's funny, when I started, I was young and I was really aggressive and I was thinking all these things and we were butting heads a lot more. Now I have a lot more respect and appreciation for why. And he's been really great in terms of letting you make your own mistakes and figure it out. But when the mistake was going to be too big, he might jump in and you might not appreciate why. I think now reflecting back on it, it's a lot easier too. But I think now it's really great. And I'm grateful for his counsel and perspective. But we are very, very different people. That's for sure.
That's great. And I think that's probably what we all hope for. Someone who will let us make some mistakes, but jump in, as you said, if maybe the mistake's gonna be too big or there's some experience there that could put us in another direction. You've been involved with a number of really great transactions, e-commerce, tech, healthcare. How do you end up focusing on this part of the market?
We focus, and this is a First Analysis thing, we've always done research in what we think are up and coming, growing, high growth areas. So we target them. So look, back in the day, we did a lot around waste management when that was a new disruptive industry back when we were founded over 40 years ago, right? We've done call centers. We've done all this other stuff. And as we looked at e-commerce or a bunch of these other areas, we're saying, like, for example, Internet of Things is a great example. As bandwidth got increasingly less expensive, it was easier to fund more of these IoT kind of products. And with digital commerce, as that came out and e-commerce came out, that's a huge part of our industry that's rapidly growing. And so it only makes sense for us to focus on that. It's directly tied in with a lot of other critical technologies, fintech with payment processing, those things, marketing automation, a lot of the front end software you see around CRMs, all of that work is critical. And we need to understand them to be thoughtful for our portfolio companies, for our clients, and frankly, for our own businesses, right? And so that's really why we focused on them. So we identified through our research, and we spent a lot of time making sure we understand the public companies, the private companies in that landscape, and have a thesis. I think it's important to have an opinion, right? It doesn't mean you're always correct, unfortunately, but I think having an opinion, and it's just going back to being a scientist, have a hypothesis, test it. And the answer should be interesting, whether it came out the way you thought or not. And I think it's important to have thoughtful, researched opinions to go at these markets. And e-commerce has been a really attractive and exciting.
What does a day-to-day look like for you? Are you doing research? Are you with companies, clients? I know there's no typical day, but what would that be like?
There's no typical day. Look, I like to meet with as many new companies as I can every week. And so I have the benefit of working across all of our industries that we focus on. And I've experts and we have experts focused in each of these other areas. But the weeks where I get to meet with 20 new companies that I haven't met with before and get to hear it and get to hear their journey, why they founded it. We love digging in with product focused companies where the entrepreneur, the founder really had a unique insight from past experience that said, hey, there's an opportunity in this market. Hearing those stories is wonderful. And then being able to reciprocate by saying, hey, here's what we're seeing in the market. Here's how you should think about financing your business. Here's how you should think about exiting your business. Whatever it might be, frankly, meeting them where they're at. We do a lot of what I call karma retainer work. You do the right things for people, things tend to work out. And so you just try to give advice. And when you meet a lot of companies, that's kind of what you do. And so that's most of what my days are like. When we're deep when we're marketing a transaction and we're looking to get an exit, I'm back to back with investors and buyers, marketing that business. If we're trying to build up interest from strategic buyers well ahead of running a formal process, I'm usually spending a lot of time reaching out to those large strategic buyers, making sure I understand what they're looking for and how they're thinking about things, and maybe advocating for some new areas that might be aligned with some of our clients or our portfolio companies where it reaches out. And then you sit on boards around our portfolio companies and frankly spend a lot of time with the entrepreneurs, helping them think through things. Look, there's good stuff, there's bad stuff. I think being really balanced and thoughtful is really helpful around that. And I think the older you get, the more balanced and measured you get around that. Also, the more transparent I think you become. And so I really enjoy that. I think, I view it as kind of a mission statement for us in terms of how we like to work, and with high empathy, high integrity and transparency, and so let's do those things. So most of my day is spent doing those kinds of things.
I love it. Great perspective, and having perspective. So important. When it comes time to talk about a business, there's the financials, the spreadsheets, there's the product, all these different pieces. And then you mentioned this idea of telling the story. You've seen many companies. What is it beyond the numbers, beyond the tech, that makes for a great story?
Look, the last thing I ever ask anyone about is their financials, because I just feel like it's crude, to be candid. I'd like to understand the business. So I love hearing the founding story and what sparked the idea in creating this business. That is always at the core. You saw this idea, here's where it is. I love hearing what the product does, how it's positioned relative to the other solutions that they saw in the market. I love watching demos. Demos are great, and they're actually challenging in e-commerce for a lot of core platforms, because if they're doing it right, the website works great or all those other things, but how it can empower a lot of value proposition. So I like spending my time there up front, building a relationship, reciprocating it, understanding where those dynamics are. And then you want to go, okay, what are those key things? Because really, there's not a founder or CEO I know that doesn't say, hey, here's what is important to us and what differentiates us. And let's prove that. Then it gets to the financials. Let's go, okay, what is the story we have a right to tell based off of evidence? It goes back to that data-driven storytelling. So my thing is whenever you're just telling a story, and I think a lot of people fall into this thing, is this story resonates. This story resonates with investors. It resonates with our clients. It resonates with our partners or buyers. If you can't back it up with your solution for your clients, dead pilots or unimplemented deals, right? Or you can't back it up with the numbers that, hey, there is momentum. Let's say you're moving up market. You're moving from SMB into mid-market or into enterprise. Let's say you have different retention or win rates and different things. Can you show that that's the thing? Telling that story without the data to back it up isn't that great. But that's why I like starting with the product, the industry, and what you're doing and why you saw it. Because I built this for this reason, I think, is the most important thing. And then these are the things I learned. And then here's where we've had success. And I think embracing failure is huge. Hey, here's where we made mistakes and highlighting them up front. I learned this from this. I don't know anybody who learns from their successes particularly well, right? And so I think embracing them and saying, and I learned this, and this is what I did, looking for repeatable motions, repeatable points of success. And frankly, the most valuable thing is always talking to clients, right? Clients, man, that's really, really, really valuable to get their perspective, especially after reaching the RFP process.
You mentioned there some of the dynamics now that you're seeing as you talk to these companies, as you think about some of the larger players in the market. When you are thinking about eComm, fintech, some of these high growth areas, what are you seeing there, and what's new and interesting in the space?
What's been really interesting about e-commerce to me is, there aren't that many platforms, like whether it's a pure B2C or B2B or a subscription platform or some combination of them. There aren't that many of them, and all of them have been around for quite some time, kind of going back to '06 or whatever, right? And there haven't been a lot of new entrants, right? A lot of them are replatforming, modernizing it. And there hasn't been a lot of investment in those, I think mainly because there's a lot of concern around incumbents, whether that's, Shopify, whether that's a Demandware, you pick them, right? Like I'm not trying to play high risk, you name it, any of those things. Everyone's like, wow, that looks really capital intensive. Why is there a right to win? So most of the innovation has been outside of those platforms, right? Where it's on the marketing automation side. You see a lot on the advertising side. You see a lot bringing payment processing into models that could otherwise be commoditized, but when partnered with new parts of functionality, I think is really, really interesting. Bringing video in, bringing searchable video in, bringing a shopping cart into video, I think is really interesting. There's a lot of new things that are happening that are all things in which we interact with content, but how do you do it? And then frankly, as a consumer or event, when you're selling to your clients, how can you prove the ROI? How can you prove it works? You saw a lot of black box solutions around this over the years that got hard to say, okay, well, what's my right to win? Or if one of those platforms all of a sudden bought something or gave something that's good enough, it was black box. It's hard to give you a lot of that color. So it's really interesting how you see around marketing automation, fintech, so the supply chain dynamic, right? All of those elements, there's a lot of different verticals that e-commerce is intimately, and you have the inventory. I mean, you have the PIMs, you have all that stuff where a lot of these are now what 8 years ago were considered relatively new technologies are considered like the new standard. And I'm seeing a lot of innovation, but not a lot of willingness to disrupt, right? I think there's a big opportunity, frankly, to disrupt through the service channel too, right? Like, a lot of these vendors are working through the agencies to implement and all those other things. Hey, there's other ways to promote your technology through some other ways. So it's moving around a lot. Most of what I'm seeing is engaging with video has been a big part of the innovation I've been seeing of late.
Well, we couldn't agree with you more. See a ton of demand for video, automating video, scaling video, making it cost effective, all those aspects. So I think it's a great area. This theme of content creation in general is obviously near and dear to my heart. I'd love to spend a minute talking about the customer. The customer is the brand. The customer is the retailer. It's the agencies. What are you seeing play out there? How do those different parts of the ecosystem think about some of the newer entrants, as you mentioned, and some of the newer technologies that we're seeing in the market?
I think it varies dramatically by the size of the customer you're going after. So in the SMB, you see a lot of legacy transaction where you're getting people up with their first site. They might have a brick and mortar presence and they might not, right? I think the brick and mortar presence ones have a stronger and are a little bit more nervous about making sure they're establishing their brand in some way because they have that existing business. Where I see those that don't have it are probably a little bit more aggressive around technology, but there's a big focus on cost and what that's going to look like. And they're heavily dependent on their agency to do it. They just don't have that much resources inside. So a lot of stuff is out of the box and kind of introduces people to each element of it. And, a lot of those clients might not even have technically a CMO or anybody for that point of buying, right? So there's a lot of dependence on the agency for looking at it. And that's the thing is in e-commerce, the agency stays heavily involved. It's kind of surprising, even as you move way up market, how engaged the agency stays in this technology. And I think it's just the way this industry was founded, where everyone's like, oh, we have this new thing, we don't know how to do it. And the agency said, we'll figure it out, or we know it. and and will adopt it. And it's never really kind of shifted to the same extent, much more so. I think once you get into that mid market, once you're getting over certain GMVs and everything, you start switching to some new platforms, and you're trying to figure out, what does that look like? How are my paths to market? And that's where I think that universe of other technology, whether it's a subscription platform or a marketing automation platform that's not native to your e-commerce platform, like the basic functionality, you start moving past it. They've been introduced to that functionality through these really, I think, efficient solutions up front. Now it starts perpetuating. And by the time you get to the really large enterprise, it proliferates dramatically. You even see a lot of these things get really concentrated in specific verticals of retail, like shoes or fashion or jewelry or whatever. And I think there's a lot of nuances around those verticals for differentiation.
Makes total sense. It's super interesting to kind of hear this perspective around the established players. Where's the white space or the blue ocean, I guess I should say, and how it changes with the scale of the customer. So I think it's super interesting to hear about.
And if I could interject, by the way, one thing that I think the playbook for most e-commerce platforms has been, let's move up market. And that's been the playbook for the last 10 years, right? Like, I'm going to start early, I'm going to move my way up. And some have had success, some haven't. I think a lot of this is, there's always concern around, hey, what can we do around Shopify and everything else, because they've been so effective at the lower end of the market. Whereas in the upper market, I think people think there's a lot more room for decision making. And I think that's true. But it also, when you're looking for investors and everything else, it might influence the level of interest you get based off of, because stickier clients, maybe it's a higher customer acquisition cost, but you have less going out of business, you have less getting purchased, all of those other things that I think really go into a lot of the investing decisions that a lot of institutional groups make.
Love it. Tell us a little about the market. We read about it every day. We see the news. It's up, it's down, interest rates are moving around. How do we think about that in terms of the broader picture and the impact on some of these companies?
Look, I mean, I think it's been uniquely challenging for e-commerce, more so than most. If you look at e-commerce, had a massive valuation bump with COVID, and so in 2021, it was on fire. And if you look at the public comps, if you look at them on average, e-commerce is one of the furthest down from that time and hasn't totally recovered, because it's, if you look across all the different names, it's still a huge part of our economy. But figuring out which the technology platforms and where there are, and the public market's a really small sample size of companies. It's been one of the areas that I think people are most worried about jumping into at the wrong place, because I think a lot of people have jumped in at the wrong place. You had a lot of money that went out in late 2020 and 2021 that now doesn't look as great at the valuations that they did. So I'd say this: I think interest rates are going to start coming down. I think that will put overall some movement in the economy for things getting better. I think the public markets, if you look at it, most of these companies, because they're not happy with their valuations, most of these companies have started moving. They've brought their revenue growth down and moved towards profitability, so that you can get to rule of 40 a couple different ways. You can grow 80% and have negative 20% or 40% EBITDA margins, right? Or you can grow 20% and have 20% EBITDA margins. The amount of public companies that have shifted to get to profitability at lower growth rates is extraordinarily high if you look in the SaaS universe. So they're all doing that because they can't continue to burn. Now, if you're still able to grow well in excess of 40%, they're still burning, right? But the other ones are going, let's do that. And you see the businesses that are break even or profitable at 20% growth doing better than their counterparts in a similar growth rate if they're negative. I'd say you've seen it's coming back to what the market always kind of used to be. So that's what you're seeing in the public markets. In the private markets, it's been even more challenging, I think. The reason why is you had a bunch of funds that got really big. They deployed a ton of capital, and this is venture growth, private equity, all the three categories we were talking about in the private market. They all deployed a ton of cash. And for a long period of time, they had been writing their investments up and returning a bunch of capital in that really frothy market. For the last 18 to 24 months, no one's been returning any capital, which means they haven't been able to return capital to their LPs or limited partners, the people that invest in their funds. And so they haven't been able to raise new funds. At the same time, there were a lot of business models out there that were predicated on relatively easy access to cheap equity capital that were burning capital really aggressively. Well, these businesses, all of a sudden, investors couldn't necessarily keep funding it or didn't want to keep funding it in the same way. They wanted to pick their winners and maybe stop funding their losers. And you couldn't find other sources of capital for them. So you've seen a major shift. Same thing in the private markets where people have brought their revenue growth down to get to break even. And a lot of people are calling it survive to 25 kind of thing, right? As a result, the bar to make a new investment got really high because people are like, look, if some of these public companies are trading at 6 times, why am I being asked to invest at 9 times, right? And so when people are, you might have the person that you're talking to about your company really excited about it, but when they go back and say, get buy-in from everyone at the firm, they're like, why are you investing at such a high valuation? So the bar got really, really high because there's so many things that might be challenging in their existing portfolio and they can't sell it, even if they want to, even at a lower valuation. And you also have seen a lot of people get killed by preference stacks where they raised a bunch of capital that money comes out first or even with a preferred return. And now those management teams are like, well, am I that excited about running this business if I don't make any money for a really long time? And so I think all that's switching out. So now I think entrepreneurs and management teams are having more rational expectations around valuation because they've had nothing but not fun conversations. And by the way, this has been really unfair to them because the bar has been switching, at least as they understand it. For me, I've seen it, and I always knew the baseline was always kind of like this, but hey, it's all about burning capital and grow as fast as you can. Now it's like, oh, you got to be profitable or else I can't do something. Or now it's about break even. What can you do on this? Like the bar has been moving. And if I was a young entrepreneur who hadn't been through this a lot, that feeling of getting whipsawed back and forth has got to be really challenging. My thing is build your business in the most capital efficient way you can. When you have repeatable motions that you know, hey, this capital, if I get a bunch of it, I can scale it like crazy, do it. But do it within your means so that you can always maintain that optionality, that you control your own fate. I can get it to break even if I need to. That's all that mess has been going on, and you're going to see it continuing to play out in 2024. A lot of people were reluctant to mark down their businesses. These venture and growth and private equity firms are reluctant to mark down their businesses. Now they're having to sell them. They're having to go out. Anybody that was selling in 2023 was either amazing or had to, or someone came in with an interesting kind of play where people felt it was proprietary. But for the most part, you're going to start seeing it's starting to open up where people are going, okay, I'm going to start selling some of my nice businesses. And you're going to see that starting to open up. I think that's going to help make it easier for people to have easier access to capital and frankly, funds to be able to raise new funds to invest again. But the bar is still pretty high. And so if you've been really capital inefficient, it might be harder. They're going, that looks scary. So you've seen a lot of people put money in where they're like, I just want to put 10 million on the balance sheet. And if you need more, I'll give you more, but let's hit these milestones first.
And then we'll see. Yeah, it makes total sense. So it sounds like, if I can play it back to you, we've taken our lumps a little bit the last 18 to 24 months. We've been through now the ringer in some ways, and there were some limitations on funds themselves and the funding. And now, if I read you right, there's not maybe sunshine at the end of the tunnel, but there is some light that we're starting to see. Bar is still high, very high, but there is some light there.
And especially if you're rational, when you're going to raise capital, if you're doing these things, don't lead with, hey, here's what I want. Be like, look, I need this capital for these reasons. The thing I'm always telling people as they're raising capital is, look, whenever you're raising capital, people are going to go, whatever round that is, let's sell 5 million, let's call it 10 million, let's call it 100. People are going to say, best case scenario, that round is expected to own at least 20% of a business, right? So if you raise 10 million bucks, people are going to say, okay, well, that best case scenario is a $50 million post, 40 million pre. And they're then going to look and say, well, how much revenue is there? If you have 10 million revenue and they're selling, I'm sitting at 5 times revenue, that feels pretty reasonable, right? if I'm growing 50% or 40%, right? If you have 3 million in revenue, that might feel pretty expensive. And also realize that that $50 million post, multiply it by 3 to 5. That's the numbers at which your investor is going to be happy getting to. What revenue is going to be required to get to those exits? That's the way things have kind of always been. And the reality is, like, you saw a lot of big frothy deals that made things seem like it was really out of control. And those existed. But the reality is, like, we've even sold companies for really high multiples, but where the next buyer was nowhere close. Like, is it really market where you got one group that needed to have this and the next one was meaningfully different? I would argue, no, you did an out of market deal, but everyone was looking at those like that's market. And look, the other thing is, as you're raising capital, take money out once you get to certain milestones. Do a partial recap. Do those things to diversify yourself a little bit. And I think investors are much more interested in saying, lighter on the growth capital, I'll give you some partial liquidity to get to the check size I want, if it means that we're going to all be a little bit more disciplined in our capital approach. So those things are resonating really well right now. But the people who are saying, hey, I'm looking to raise $10 million or even $5 million, and I'm going to give up 5% of the company, you've killed the conversation before it even began, and you don't even know it.
Matt, such great perspectives. Before we head into my wrap-up questions, I got to ask you about AI. It's in every conversation. You see hundreds of companies, I want to say. You talk to so many, the big strategics, like you said, the growth, the early. Where does AI fit into all this when it comes to these different parts of the market?
It is all over the place, and there's a bunch of different decisions to make. Like, for example, we have portfolio companies that are building their own proprietary generative AI because it makes sense for their particular application. We have other portfolio companies that are saying, why on earth would you ever do that? Leverage these other platforms. And you see all these, you used to see the same sort of thing with, in-memory databases and those sorts of things, right? Look, AI has been critical across all of this for a long time. We've invested in NLP, kind of things on the healthcare side, machine learning platforms in probably more structured environments. I think you've seen big impacts on this generative AI on LMS platforms and those sorts of things where content, and there's a lot of efficiency that can be driven. So I think in almost everybody has to go, hey, here's where AI fits on my solution and where it makes sense and where we're protected, where we have a moat and where this gives us advantages. I don't know if it makes sense for everyone to run and incorporate it into their platform depending on where they are. I just had a conversation with an e-commerce platform where I'm like, I don't know if pushing forward that AI strategy right now at your stage of company is what I would do if I'm planning on doing a transaction in the next 12 months. I'd say, hey, post this transaction, this is exactly what I think we should do. But is that AI is it generating revenue for you, or is it generating efficiency? And sometimes it's both, right? And I think you just need to kind of look at those things. A lot of the really exciting things are efficiencies within these businesses, right? And how you go. But there's some really neat opportunities for, frankly, even getting into a new business line where the moat and the barrier was much, much, much higher before. And if it's integrated into your differentiated platform, it might be worth more than the traditional commoditized approach. So, the reality is it's really, really important. It's really exciting. We're spending a lot of time on it. And I think it just because it's AI doesn't mean you have to throw it out there. Like, how does it really apply in a practical way into what you're doing?
So if I could sum it up, if AI fits into your right to win, you should do it. And if it doesn't, maybe put it on the roadmap for something down the line.
Depending on how you're funded and what you're doing. And what business you are, it can really just vary, and what your competitors are doing and what your client, listening to your client is the most important thing you can do. If they aren't ready for it, and these things are evolving. And then, but again, some of the things for your efficiencies, it might help you save a tremendous amount of capital too. So yes, depending.
Well, Matt, I've really enjoyed our conversation. If you would, I'd love to ask you a couple questions before we wrap up here. The first is, in your professional life, and I know it's hard to choose just two, but which two people have influenced you the most?
Probably the first one was a guy named Jim Hickey, who was my boss at William Blair. He's now at Vista Equity Partners. He believed in me and was patient with me and highlight and was really constructive, where a lot of the lessons he taught me I didn't really appreciate until much later on when we weren't working together, but I'm really grateful for him. And by the way, my dad's first on this, but I already hit him, right? But I had two clients that really taught me two different things that I thought were really helpful, if I may. So one was a guy named Kurt Long, who had a business called Fair Warning. It was a healthcare cybersecurity business. And Kurt really taught me the importance of culture, which isn't necessarily inherent in venture capital and investment banking like we do. And at the same time, I had a client named Andre Lavoie, who has this really interesting HR tech company called Clear Company. And he sat down and he goes, "Matt, you gave me all these wonderful insights into my business, and it seems like you applied none of them to yourself." And those two together at that time, and this was 2017, totally changed how I thought about my business and how I could start leveraging these insights, which sounds so dense, but I'd say those two, and there's many, many, many more, but it hit me at the time that frankly, every incremental group I work with has taught me so much more because it helped me start applying them to myself and our team and how we do things. And I'm super grateful for all those people.
Great people to have in your life overall and for your career. So really amazing stories and influencers there. Tell me about when you do get a few minutes, a little time outside the office. I know you're on the road a lot, flying around, meeting with folks. When you get some downtime, what are your hobbies? What do you like to do outside of work and family?
So music is my biggest one. I played in bands for a long time. I play a lot of music. I still like to write music, but I love going to shows. And my wife loves going to shows. And so we do a lot of music. So that's probably the primary thing. I had to quit skateboarding last year when I replaced my knee. So skateboarding was a big one. And once you're a skateboarder, you kind of always consider yourself a skateboarder. But I've got 3 kids. I love spending time with them, and cooking, I'd say, is probably the other big one. Outside of this, the general reading and everything else. But I love cooking, and I love cooking shows.
Favorite dish?
Oh, that's impossible. I mean, I don't even know where to start. Honestly, I honestly have no idea where to start. But anything that's pizza is usually pretty good in my book. But no, I love everything.
Matt, if folks want to get in touch with you on the web, online, what's the best way for them to reach you?
Look, you should be able to contact us through our website, firstanalysis.com. And please engage with our research or through LinkedIn or anything else. And look, we have a very open door. I love engaging with people across our firm. And if I'm not the right person given your industry, we'd love to put you together with anybody else. But, we're excited to talk to people and love talking with people who are passionate about what they're doing.
Matt, it's been a pleasure. So many great insights. Thanks for taking the time to talk with me today.
It's my pleasure. Thanks for having me, Dave. I really appreciate it.
I hope you enjoyed today's show. Beyond the Shelf is brought to you by It's Rapid. It's Rapid is the platform Pepsi, Sierra Nevada, Revlon, and hundreds of other leading brands and retailers use to build personalized content at scale. Whether that's images, videos, or product descriptions for their product detail pages, shoppable videos or banners for their digital ad campaigns, or sell sheets for sales enablement, brands that use It's Rapid are able to produce high-quality, on-brand content on average more than 80% faster than category competitors. To find out more, please visit itsrapid.ai. Thanks for listening, and we'll see you next time on Beyond the Shelf.